Hello, welcome to Fundamentals for Startups, a CoMotion Labs production. My name is Zach Chamberlain. I'm the Life Science Incubator Manager over at Fluke Hall, and I'm your host today. We are a multi-industry incubator that specializes in hosting early-stage startups from both inside and outside the university. Our entrepreneurial community provides critical infrastructure and opportunities for learning, mentoring, and networking. And we are always looking to connect with founders in life science, hardware, and tech. Fundamentals for Startups is an open lecture series on topics related to entrepreneurship. Every week we bring new experts to share insights and answer questions. Subscribe to our YouTube channel for all the Fundamental Startup presentations and visit the CoMotion's website to keep up with future events. So today, I'm excited to introduce Magnus Christerson. He is an angel investor at Alliance of Angels. Magnus is a software engineer, tech startup veteran with a focus on AI. He will talk about navigating investors and founder perspectives and common reasons startups don't get funded. Welcome.
Thank you very much. Can you guys hear me in the back? Very good. All right. Well, I'm very happy to be here. I think CoMotion is a fantastic institution at a fantastic university, so I'm very pleased to see so many people here. How many here are founders? Great, about half. And how many here are investors? I know one at least, yes. And the rest of you, are you just interested in maybe starting a company one day? Yep, maybe, yep, that's good. So I would like to make this very interactive. So I'm here for you guys. You should ask questions. You can interrupt my flow here if you want. There's no stupid questions. Feel free to ask anything during the presentation. We will also have plenty of time at the end to discuss more. I think we're supposed to end at 1 o'clock, right? And so we have a time end there. Okay, first a little bit about the organization that Zach mentioned here, Alliance of Angels. We are a Seattle-based angel group. We have about 200 members. Most people live in the Pacific Northwest, mostly in Seattle area. All these are angel investors. They've had some successes in the past. A lot of us have sold companies. A lot of us have been founders. A lot of us just like to be around founders and startups. We have lawyers, we have doctors, we have engineers. A lot of people coming out of Microsoft, Amazon, Google, Meta, but also a lot of people coming out of UW, coming out of life science. There's a tremendous life science ecosystem here. A lot of life science successful founders have then become angel investors. And why do you become an angel investor? Well, if you want to make money, it's actually better to invest in an S&P 500 index fund. That's the probability of success is higher there. However, a few angel investors actually outperform S&P 500 index fund, but the sad truth is that most of them do not. And that's a sad truth. However, if you look at the startup success ratio, and there are a lot of studies around this, but at least half of them will fail. Some people say 90% will fail. So you need to be in the 10% if you're going to have a successful angel investment exit here, right? So that's a little dirty secret. However, how do you become one of those successful founders and successful investors? Well, you have to look at the details of that particular deal that you're investing in. And that's what I want to talk about today. What are the things that a good investor, and I'm not saying I'm good, but another good investor would look at. And I want to tell you as a founder, and maybe also a future angel investor, what are the things that founders can do differently to increase the likelihood of funding, but also, more importantly, increase the likelihood of success in your company. Okay? So I like this picture here, founders and investors. We have a dialogue, right? Founders have a lot of ideas, it's chaotic, it's a lot of random thoughts. investors, we have a very, very structured process of how we think, how we evaluate deals. So at the Alliance of Angels, we see about 100 companies every month. 100 companies come in, we look at them, and we pick 3. So 3 companies get to present to our 200 members. And of those 3, maybe 1 or 2 get investments. So out of 100 companies coming in with chaotic founders, 1 of them, or maybe 2 of them per month, will get investments. And we invest maybe in 15, 20 companies a year. And we see over 1,000 companies every year. So let me stop there and just ask you guys, what questions do you have? What do you want me to cover? What are the things that are, oh, I just need to answer this question? Yes, we have a microphone coming here, right? Yeah.
If you look at like 1,000 companies in a year and you're only investing in 15, do you think that too many companies are pitching too early?
Yes, that is true. Yep, answer is yes. Any other questions? And let me come back to that. What can we do to fix that?
How do you perceive the chaotic nature that the founders are coming to you as? Is that off-putting? Is it like, yeah, how do you see that?
Actually, I mean, I've been the founder myself. It is chaotic. And so you just need to deal with it. And the thing to do, though, is that how do you create some kind of structure around the chaos you're in? And I want to talk a little bit more about that. Actually, I'm going to talk a lot more about that in the second half. So my presentation is first half will be around what do we as angel investor like to see from a founder? And then the second half of my presentation is, as a founder, what would I recommend to you actually do as a founder? Okay? Any other questions? Yeah.
Yeah, for efficiency of time, the angel investment has a split for the 15 companies of the year. We want 8 in AI and spread. So how do you pass the message to the other side? If they're coming with physics, you're in the wrong area. This year we're not looking.
I'm not sure.
So
what is the question?
How maybe some of them are too early. Maybe some of them are in a space that your side has decided not to invest that particular year. So, how do you get that message across to save everybody's time?
Yeah, so we have plenty of information on our website where these are the companies we're looking for. This is the information we want to see. So we're trying to get put that information out there. We also host office hours. So every week we have a few of our angels. They sit online. It's free. You can sign up 30 minutes, talk to an angel. And if you think, okay, I want to go and pitch, go sign up for office hours, 30 minutes, say, okay, I want to pitch. Here is what I want to pitch. And the angel, and I've been doing a lot of these office hours, the angel will tell you, you're not ready. This is why you're not ready. Fix these 2 things and then come back to office hours. So we do office hours as a free service to the community, and you can come there and see and get real-time feedback from an experienced angel. One more question in the back.
Yes,
yeah.
Hi. Thanks for sharing your insights with us today. I was wondering if at some point in time you could share with us what kinds of things will investors be expecting of the startup? So we're asking for money. What might they be asking for in return?
Yes, very good. That brings me to my first slide, or my next slide here. What are we looking for? So this will be the agenda for the first 30 minutes here. And it looks pretty straightforward. I mean, this is what, if you look at what should a pitch template look like. If you go to Alliance of Angels, we have our pitch template on our website. And it's pretty much all these things. And I'm sure you've seen this plenty of time. Now, let me walk through each one of these and say how people are misunderstanding some of these things. So first of all, you need to know your problem. And this sounds very obvious, but a lot of companies come and say, well, there's a mental health crisis going on, we should fix the mental health crisis. So that is, yeah, that might be a problem, but it's not a problem that a particular startup might be able to solve. You need to have much more precise, what exactly are you going to do? What is your solution for that? And the solution needs to be something that is investable. Typically, it's a product. It could be a treatment. It could be something that is. It could be a service. If it's a service, we tend not to invest in services. It could be an idea, which is great, but then it's not ready as a product. So you need to think very, very carefully about exactly what problem are you solving, and articulate that very good. Now, coming up with, well, there's a crisis going on in this space. I'm sure that's true, but you need to specifically go down to this particular problem we want to see. And the problems needs to have some backing, because we as investors, we are not experts typically in the problem space. So you need to have evidence saying, this is how I know this is a problem. And if you can quantify that problem, it's even better. Now, many times a startup has, okay, here is the problem, here is my proposed solution. And many times it's kind of predictable. And then you want to ask yourself, well, why hasn't anyone else solved that problem? And then you look at what are the things that you will do differently? Because if it's an obvious problem and an obvious solution, there must be some kind of other attempt out there. So if you look at problems, should problems be big or small? Now it's getting into target market. Let's say you found the problem, you have evidence that it's a problem, you have data around the problem, and you have evidence, an indication that your solution will solve that particular problem. Now, what is a good evidence? Well, if you have paying customers, that's a good evidence, right? But that typically, if it's sometimes we invest in companies that actually have paying customers, and those are the best companies. But typically, if you start having customers, revenue, then you're on a journey. We typically invest right before that starts. So we're looking at that transition point where you start seeing traction, and that is what I'm going to talk about soon here. Now let me talk about target market. Let's say you found a problem. What market is that problem, and what is that particular target market? And here's a trick question: do we want a large market or do we want a small market? What do you think is better? The larger the better. And if it's a large market, will you be unique as a startup? Right. So we have kind of a benchmark rule. We want the larger the market. A lot of founders say, "Oh, this is a huge market. It's $1 trillion market." And first of all, there's no $1 trillion markets out there. There might be $1 trillion problems, but and market is defined by how much money people spending today on that particular problem and products for that particular problem. So as investors, we're looking at, yes, there should be a good market, but it's not. You need to kind of define your segment of that market. So as a rule of thumb, we are looking for a target market of at least $1 billion. Because if you work backward, if there's a market of $1 billion, maybe you can get 10% of that market. That's 100 million revenue, which is 100 million. That's a good number to exit a company at. So as an investor, we're looking at that. If your target market is, say, $100 million, you will get 10% of that market, maybe. So that's $10 million in revenue, which is now might not be a good deal, right? So we have a rule of $1 billion target market is good. Now, that $1 billion, that might be, everyone knows what TAM, SAM, and SOM stands for. Total addressable market, what is it? Serviceable addressable market, and obtainable market, right? So the TAM is the $1 billion market. Now, you don't want to go after that. Well, you cannot go after that all alone. So as a startup, you want to go after a very, very small market. Because if you go after a very, very small market, and that's where SOM comes in, you want to have a very, very specific SOM. Because if it's a market you can actually address, your success rate there will be higher than if you go after a broad market. So as an investor, we're looking at, is there a target market TAM of at least $1 billion? And have you found a niche within that market which you can win? And if you start actually having 2 or 3 or 4 customers in that particular niche, that shows that you're starting getting traction. And traction is kind of the next step here. So how do we know that, okay, you have a problem, you have a product as a solution for that particular problem. The target market is at least $1 billion. And you are actually starting to engage with customers in that particular target market. Now, everyone knows what product market fit is. So what's the product market fit? Anyone can define it? It's pretty easy. Is there a fit between your product and the market? So this comes back to, okay, you have a product, you have a market, is there a good match? And how do you know it's a good match? Well, people like it, sure, but what does that mean like? Do they actually pay for it? Do they use it? Do they write good reviews around it? The best indicator is that there's actually a customer who's paying you for that particular product in that particular market. That is a good evidence. And if you can repeat that with multiple instances, that is a very good indicator. So as an investor, we always look at that product market fit, and we look at, is there traction in there? And most companies that come to Alliance today, they have not reached this point yet. And this is coming back to your question, is it too early? So a lot of founders come to us and saying, I have this problem, I have this solution, the market is $20 billion, and I have this product in the market, and I have my first user, and they're very happy. Okay, do you have more than one user there? No, but he's very happy. So that's a good first step, right? But can you repeat that in your SOM? Remember we talked about SOM. It's very clear, because if you want to have a SOM, that's easier to spread because people talk to each other. So you want to see this viral component that the product can actually spread from there. And then from there, they can grow up, right? So we're looking at this inflection point where, okay, product, market fit, and you start seeing the traction. So we're always looking at, is this the beginning of that hockey stick? So whenever the hockey stick starts going up, this is where the risk of the startup is going down, because you start seeing evidence that you have revenue, and your revenue is going up. So that inflection point is where all the investors are looking for. Can I get to that point? And if you get to that point as a founder, you're golden, because now people will throw money at you. Okay, how much money do you need? Can you scale faster? Just grow. How to get to that point is a journey. It's typically not the first idea you have, and I will come back to pivoting later on. You might try something first, and you see it's not quite, customers are interested, but it's not a high priority for them. So that's not a good product market fit then. And as a founder, you need to be able to change your mind, saying, okay, I tried that, but I'm not sure that is working. Let's try something else. Now, being out there in the market will teach you a lot. It will teach you, is your thinking correct or not? And maybe you have an idea and it doesn't match that particular market. And we're going to talk more about how do you pivot. So back to your question. So when companies, we'd rather see them pivot before they come to Alliance of Angels than after. Because if you have taken money and you come to the investor and say, I think I need to pivot. So as an investor, I think pivoting is a good thing. But pivoting could be expensive too. So whenever you see as a pivot, you see, okay, well, it's a good thing you've figured out that your first plan didn't work, you're trying your second plan. Now how much more money do you need? And then you can decide, okay, keep going here, right? And then if you come pivoting the third and fourth time, you kind of, well, this is getting long in the tooth here. So it's much, much better to do the pivoting before you get funding, because when you take funding from investors, the clock starts ticking. And the message here is that pivoting is a good thing, but try to do it before you raise at least a lot of money. You can start getting some seed money, but be careful about are you ready to actually Do you actually have product market fit? This is why it's so important at that point. Let's see how we're doing on time. 20 minutes into, we're doing great. So how do you plan to make money? That's kind of the next question. Okay, you have a product, you have some first customers. Now, what is your business model? How will you make money here? And this is often also many founders come in and say, well, we're trying this now. It's fairly service intensive, and customer acquisition cost is a little high. So this is often a dialogue, because most founders haven't figured this out yet. But there is some embryo of an idea here. How do you plan to make money? So this is something that we look to at. It's sometimes called the business model. I think business model is too high over the world, right? Just make it very, very simple. I'm going to charge this. I'm going to have this many customers. Here is the trajectory. And all investor pitches come in at, and in 5 years it's going to be millions and millions of dollars. So they're all like, we're here now, nothing, but in 5 years it'll be up here. And we always laugh. Okay, for sure, that would be great. But let's talk about next quarter. What are you going to do next quarter? Actually, what did you do last quarter? Oh, there was this much, but next quarter is going to double. Okay, did you double the previous quarter? So in investor, they will start asking you very detailed question about near term. Forget five, great if you do 5 years, but we're looking at right now. Do you actually see that you have and this is what I talked about, the traction and the growth. So growth is, do we actually see that your plan is working or not? And we're looking for evidence. We're not looking for dreams, right? Dream is great, keep dreaming, but we're not interested in those dreams. We actually, I think, I was looking at this last night, and our template actually say we want to see a 5-year financial projection. And we do want to see that, but we're not going to take it very seriously. We're just going to see, have you actually thought it through? Because we're looking at that 5-year projection, does that match with your plan around TAM, SAM, and SOM? So we're looking at, do you have a consistent story? And it's very, very clear that if you're making things up, you're going to see that, well, this doesn't match up your plans here. Okay, now let's say you have come through there, okay, this is how I'm planning to make money, and this is our first approach, and we're probably going to change that to something else later. Now, okay, what are the alternatives for your customers? What are the competition out there? And do you have a defensible position? So we'd love to invest in founders that have a moat. Now, a moat is very difficult to get, and sometimes people say, well, I have a patent. Well, a patent, maybe that's a moat that works sometimes in some markets, but mostly it doesn't work. So what is your moat? And especially I'm looking at a lot of AI companies now, and I always say I want to see AI with a moat, and no one has ever seen anything AI with a moat. And I do a lot of work in Silicon Valley, and the thinking there now is essentially, well, execution is a moat. We move faster than anyone else. I said, okay, yeah, OpenAI moving faster than anyone else. And maybe that's a moat, but is that a sustainable moat? So I think a moat is a great thing to have, but many times it's very, very difficult to find a realistic moat here. And I actually think execution might actually be a moat, because things are moving so fast in AI that if you can move as fast, or at least not be left behind, that is a good thing, I guess. Many times founders look at competitors, well, here are the other players, and it's very interesting to see who do you pick as your competitors. And sometimes you define them very, very narrowly. And of course, sometimes you have the 2x2 matrix, and we're always up in the right-hand corner. So the axis you pick, or the evaluation criteria you pick, it's very telling for us as investors. So how do you think about your solution compared to others? And who do you compare yourselves to? Sometimes we see, well, we are here, and Microsoft is here, and we have more than Microsoft. Or we have more features, or we have some unique thing that so if Microsoft is your competitor, then it's like, okay, time, okay, we're done with this meeting. So you have to be realistic about who you pick as your competitor. The most insightful is of companies I've never heard of. Like, oh, these are 2 startups. They just got Series A funding from those guys. Okay, that's kind of interesting. There's someone else investing in this particular space. And then you want to such a double click on that. Well, why did they invest in those companies? What do they do? We looked at the company here earlier this year, which was doing, you know what coding in medical records are? Like billing codes. Like this, doctors say I did this and that, and then someone has to transcribe that. Oh, that's billing code 065543. And it's like, oh, how do you know that? Well, you have a lot of experience with billing codes. So this medical coding is a big problem. People are spending a lot of time, and it's all fully manual today. So we looked at the company that have trained medical records and billing code into AI, and they now have like 85-90% correctness in the medical billing code. I said, oh, that's good. That's certainly a problem. That's actually a good fit for AI as well. And this was actually backed by a medical billing company that's doing this as a service today. So I looked at, oh, that's a very good application, and it's correct, and they have trained it very well. And then I looked at, okay, what are the other companies? And they were looking for, I forgot, I think the valuation was like $10 million or so. And then I looked, and this was not part of their presentation, by the way. But I just, okay, some other people must have done this. And I found this Silicon Valley company that just raised Series B, $100 million. And you looked at on their website, hiring sales managers. So they're just ramping up sales, and they got $100 million investment. And so they are clearly moving, and we are going to compete with those guys, and they were not aware of them. It's like, that's not a good sign that you're not aware of what's going on with your in your market here, right? It's a good idea, but maybe, you know, how are you going to win against someone that's like not only 1, but probably 2 or 3 years ahead of you and ramping up? Let's see. Team, so, yeah, please. Yeah.
I don't think I'm that quiet, but okay. Can you give a specific example of an optimal moat that you've seen in founders, or is it a combination of all of the defensible methods that you've said?
Yeah, okay, yeah, no, that's a great question. How do you create the moat? As I said, many people look at patents and IP or trade secrets, and those are okay, and especially if, I mean, I think my experience, the patents works against the big guys, but not against, not internationally, not small people. And the best moat I know is that you are the category creator. Like, you know, a category, if you actually can create a new category, and you are associated with as a brand to that category. And my first angel investment was actually, we were so, well, it was a lot of work, but I love to invest in companies that have an ambition being the category creators. Because if you build a category, I mean, it's building means it's zero. There's no category earlier, and you build that category, and it becomes bigger, right? Then if you are associated with that category, you have a dominant position by default, right? That's like I don't know if you're familiar with the gorilla game. Like, you are the gorilla in that category. It might be a small category, but it's bigger. That's very hard to replace. That's an example of a good mode. Yes. Right. You have to ask yourself, you're a thought leader, but are there other thought leaders? And will there be new thought leaders that's going to be better than your thought leader? So, how do you define a category? Category is a good question. So category is in the minds of the buyer, right? What is this? Is this an electrical vehicle? Is it a long-range electrical vehicle? So something that is in the buyer's mind. There is a great book called Positioning, about how do you create categories. So when you think about the example that I mentioned earlier, so this is a category of, this is a database. It's a graph database. So database is a broad category. Database has been around for years and years and years. In my first 3 companies, we ended up building our own databases because the relation database just did not fit with us. And I ran into these 2 guys in the garage and said, well, we had this problem, we tried to use relation, it didn't work, but we're working on this. this is a way to store a network of nodes on disk. Oh, that's pretty cool. And we didn't have a word for it, right? That's very different, but that looks like an object database. No, it's not, blah, blah, blah. So anyway, so I invested in them, and this is very promising because I've seen this problem at least 3 times, and I know other people have it too. So problem is there's no market for it because there's no one buying it more than people build it themselves, essentially. That's, by the way, a very good clue that people build it themselves. That means that there's a need there because people are investing services. Now, we were so, okay, so we got first few users. It was an open source project. And then we said, well, okay, how does this, what do we call it? We said a network database? Is it, well, mathematically it's a graph, so how do we create that? And this was just, if you guys remember the NoSQL, there was this backlash against SQL databases, so there was a NoSQL paradigm. So, well, NoSQL is a great tsunami that coming over. Let's hang on to that. Let's surf that wave. So let's define a new category called graph database. So if you go to graph database on Wikipedia, go to the first creation of that page. I created that page after we have like, okay, let's call it that. So that started promoting that. And then the founder, he went to all the NoSQL events and promoted, oh, there's graph database, there's key value stores and so on, right? Document databases and relation databases. So this is a different. And today they are the market leader, category leader in graph databases. It's a sub-segment of databases, right? And they are 1,000 people. They are 200 million ARR, valued a multi-billion-dollar company now, and still a private company. So this is a good way to create the moat. No one can compete with them now. Microsoft launched a graph database, Amazon launched a graph database, IBM launched a graph database, Oracle launched so they have all the big guys going after this little tiny company, right? And customer are picking them. They're so ahead of it. So that's a good moat. That's very hard to replace. Okay, yeah.
Coming back to the discussion about moats, when you say the best moat you could possibly have is being the category definer, isn't it difficult as an investor to invest in such companies because there's no prior evidence that this is going to work?
Yes. No, you're absolutely right. So, as I said, I love to do category defining products, but it's very difficult. And as my story was, you don't know that initially, right? But you can see like there's this pattern where, well, this is something different. And that's why I think if you think about market segmentation is often the answer to many of these problems, right? There is a big market, but if you segment the market, this is like, I brought up electrical vehicles. Yeah, there are vehicles, there are cars, but electric cars, that's a market segmentation that maybe didn't exist before the first, like there were hybrid cars, but then electric vehicles, that's an example of where you have a big market, but now you start resegmenting that market. So market segmentation is usually a good thing, right?
So a defining category the best possible defining category to be defined is a smaller segment of an already large market.
Usually that is how it works, right? But if you think about, so what is, say, Elon Musk, SpaceX? What was his pitch, right? Well, we need to be multiplanetary species. What is that for market? We need to build multiple planets. There's no market like that. But that was clearly a strong vision statement, right? This is a new category. Okay, we're gonna be an interplanetary species. I think that's an extreme example, right? It's to be counter. It doesn't need to be. The market maybe not doesn't exist. I mean, there was space travel before, so think about that as there's usually sometimes called adjacent markets. That's close by, right?
Thank you.
Okay. Let's see. We are now a little bit behind, but that's okay. The team is very important for us. We want to talk to people on the team, usually as a single founder, or usually there's 2 or 3 co-founders. It's very good, but you should also be aware of where are your weaknesses. So sometimes we ask, well, who would you hire next on your executive team? So you should have a pretty good idea about that. And if you say, well, we should hire a VP of sales, that is a red flag for us. Because a VP of sales is great when you actually start seeing that one. But you say, well, now we built the product, now we have to hire a VP of sales to sell it. Well, you as a founder, have you sold it? Have you sold it? No, but I'm not the sales guy. Well, sorry, that you need to be the, we want to see the founder needs to be the first sales guy, because that is how you learn. You go out and sell, and if it's not working, then you need to pivot. And if you have a VP of sales and saying, oh, doesn't work, well, fire that and get a new VP of sales. And a lot of companies that have invested, they go through and fire VP of sales, and the problem is not the VP of sales. You can get the best. The problem is back to product market fit. And this is why we're very sensitive to this when we're looking at who is doing the selling. And you as a founder, you need to be, I know it's many of us founders are introverts, but you need to actually be out there and see firsthand what is working and not working. Okay, the last thing we typically ask for, and this is surprisingly many startups don't have a good haven't thought this through, right? Okay, sounds very good. Now, what is your ask? What do you want from us as an investor? So, well, I would like to raise $1 million. Okay, how you want to, what is that instrument? We can do a SAFE or convertible note, or we can. So if that's a vague, that's not a good thing. So as investors, we want to see very, very clearly, have you actually, do you have the documents ready? Do you have a lead investor have a lawyer that will actually review it? And I have the three most common things we do is price drawn, which means you buy shares in the company, and the shares is 12 cents a share. That's very clear. That's very clear. And besides, so how many shares are outstanding? How many shares are authorized? So we look at all those things. But price drawn, I wouldn't say we love it, but it's one of the best. It's very clean. Now you need to have paperwork to get all that done. Right? So it's pretty complicated. Plus, you need to have a valuation, and usually valuation is very difficult. Well, if it's 12 cents a share and how many authorized shares you have, that means that your valuation is $12 million. Well, how do you know it's $12 million? Why not 8 or 20 or so, right? So that's why convertible note comes in. Okay, we don't know what the valuation is yet, but it's you loan us money for now, and then that will convert into equity at the later point when we actually have a lead investor and we have a valuation. So convertible note, we are okay with that too, but that is a loan. That means you pay interest. That means we want to see like a discount. Well, now we're taking a big risk, and as I said, we could put that money in S&P 500 index fund instead, but we give it to you because we believe in you. And at some point in the future, there will be an investor that comes in. Okay, you're worth $15 million, and then they will convert. So convertible note, we actually prefer that to SAFE. SAFE is very, very common. It came out of Y Combinator about 20 years ago. And SAFE, it's a simple agreement of future equity. So it's a promise that sometime in the future you will get equity. And if you look at the first SAFEs, they were pretty much that. Okay, you give us $200,000 now, and in the future we'll get equity. And okay, at what valuation? Well, we don't know. Whatever valuation will be. Well, why don't I just wait to invest when you actually know your valuation? So Y Combinator got a lot of backlash. So now they have introduced SAFE with caps, SAFE with discounts, SAFE with interest. And so SAFE start looking more and more like a convertible note. But the reason, and I know a lot of we have 200 angels, a lot of them will never invest in a SAFE. SAFE is more popular in Silicon Valley. Here, I would guess maybe a third of us would invest. I've done SAFE investment, but I don't like it. Because we know that most startups will actually fail. And if you fail, SAFE, you wipe it out clean, nothing, right? Even if you sell it as an asset, nothing. Now, if you have a convertible note, you actually have a loan, which means that if there's a liquidity event, like someone will buy your assets, you as a debt holder, you actually get some of the money back. So convertible note is actually a little bit of protection on the downside. And we need a lot of the protection on the downside because most of our investments will go to either zero or close to zero. Many angel deals end up being about 1x. So founders work for 5 years, and then they sell it as, okay, an acqui-hire or an asset sale. And then it's typically, if there's an asset sale, you actually get your money back in convertible note, but on a SAFE, you get nothing. So that's why we are not very fond of SAFEs. Okay, So that was the first half of the presentation. Yeah.
Two questions. Maybe the first is a comment. Going to your category, being a differentiator, all the examples you used were kind of like delta changes. And, you know, you didn't touch, like, for example, a completely disruptive, you know, like the first smartphone, why do you need it? Is it a bit of a philosophy from your angel investment on, you know, angel is, as it is risky, we don't want to have a completely out of the world category where, you know, we don't know. Am I thinking right?
Yeah, no, you're absolutely right. And many times you don't know if it's a category-defining product or not in the early phase. And so you're absolutely right. You might not know, but sometimes you can sense that this is different. This is different. Is it like that, but not quite. And many examples of new categories they're like that, but they're different in a significant way. And a significant way in the minds of the user here, right? So I'm very excited about all the fusion companies, right? Yeah, it's energy production, but it's very different. And maybe it will work in our lifetime, maybe it won't.
Yeah, so you use the adjacent kind of as a measure there. You use the adjacent category as a
Yes.
you know, to get a grip on it.
You're absolutely, yeah. So if you think about it, okay, there's always a market that's bigger than your category, right? You can expand it like, okay, it's a consumer packaged goods. There's a lot of those, right? You can define that as a market. So markets are like defined as, it's like hierarchical inside there, right? Here's the sub-markets. And typically, you're right, typically if you see a new category, it's typically part of a bigger market.
Let me switch to my second and last question. A little bit earlier, you talked about the progress per quarter. Lot easier for a later stage investor to use ARR and, you know, once the revenue kicks in. For an angel, what is the metric that you think about?
Yeah, so some Series A investors have metrics on those things. We as angels typically do not. We sometimes put multiples on revenue and things like that, but it's very different from different products. So I would say we are not as structured financially, and that's kind of part of the seed investment phase. Yeah, exactly. Yes, exactly. Okay, yes.
What's your perspective on founders that have some level of funding prior to approaching you? Do you prefer to be the first person to really invest, or what is the limit or cap or where that money comes from?
We love the founders that have put in money, and usually it could be grant money from a university, it could be SBIR, it could be like non-dilutable funding. Those are great, but when that happens, are there any strings attached to that? Do you have to do something for that? And that is, well, if that is in line with what you want to do, that's great. But if you have to do this while you really want to go here, that's not a good thing, right? So one of my startups, we actually got the DARPA funding. I got over $6 million from DARPA to essentially build products along our line, right? So that was a great fund, non-dilutive funding, and also that opens a lot of doors, those things. Now, we usually say that the first funding for a founder is typically the 3 Fs. Friends, families, and fools. So we typically don't want to be in the fool category. If we are in the friend or family category, yeah, that's okay. But the 3 Fs typically comes in before angel comes in. Now what's changed recently is that there's a lot of these venture capital companies that have become seed fund and pre-seed fund. So in my mind, a pre-seed VC, that's just blows my mind. What is that? And I think we saw a lot of that when money was essentially 0%, and I think maybe some of that is disappearing. But we see a lot of that, and I think that's great, and that there's more capital for founders to go after. Okay, are we good? Let's move on to this is a question I ask. How many here knows who Steve Blank is? Yeah, typically. So when I ask this in Seattle, it's typically 10% of founders. If I ask this in Silicon Valley, it is 90%. So, of course, I took his class. Oh, yeah, you follow him big time. So Steve Blank is he's been founding or co-founding or be early employee of eight Silicon Valley companies. He has some of them crashed, some of them went okay, and some of them went IPO. And he then looked at why were some of these going up, some of these going down, and then he became an angel investor after his IPO. Okay, I'm going to put money into companies as well. Then he said, well, some of them are doing well, some of them not doing well. What's going on? We kind of do the same thing ever, but then he looked at the details and he said, no, actually we didn't do the same thing. And what are the things that are pattern for the companies that are doing well? And he became then and started teaching this at Berkeley. And he wrote this book, The 4 Steps to the Epiphany. And his IPO company was actually named the Epiphany, so that's a funny thing here. This came out like early 2000. He just updated here, The 4 Steps to the Epiphany. It comes out here. So he actually goes through, and then he started teaching this class at Berkeley, then Stanford, so he teach it here as well. And have you heard about Lean Launchpad, Lean Startup? All of these things are coming out of his work. This is the Lean Startup book, Eric Ries, right? So he was an angel investor in Eric Ries' company, and actually the company that Eric talks about in this book, it was actually his 3rd angel investment in one of Eric Ries' company. The other 2 companies, they failed. So Eric came to Steve and said, "Can you invest? We have a new startup. Do you want to invest again? What are you going to do different this time? The last 2, they went to 0. Well, we had this new idea, blah, 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 blah. You know what? I'll invest, but then you have to go and take my class at Berkeley." So okay, you invested, and then he created the class at Berkeley. And then they actually started adopting some of his ideas here. He came out later with this startup owners manual, which is very prescriptive way. Now, and there's a lot of these, the entrepreneur's guide to customer development. How many have ever heard of customer development? Right, there are more hands going up now. And so this is I would say the father or so, but he started this whole movement. And today in Silicon Valley, you will not get funding unless you follow his principles. That is just no way. Before the talk today, I sat out here and I read this book. I started reading Pattern Breakers, came out 24, this book. Have anyone heard of it, seen it? Yeah, Pattern Breakers. So here at the bottom it says, one quote, and who is that from? Steve Blank, co-creator of the Lean Startup movement, the most important startup book of the last 10 years. So he is the #1 reference for the latest business book. So anyway, we only have 10 minutes left here. So what does Steve talk about? So if you follow his idea, and I think this is the kind of way we talk a lot about these things. So it's essential that the startup journey is a process where it's really a search initially. Search, like, what are the customers? How can you discover customers? And how do you validate? How do you get proof that these are actually customers? And usually, if it doesn't work, then you pivot, you go back and do, okay, what other customers could we find? And you iterate on this. And he classified this is a search, and he has a lot of tips on how to actually do this search, customer discovery. Then, once you see, oh, it actually sticks now, then you see, like, okay, now I can go over to execution mode. This is where you see these things taken off, right? Okay, let's start creating new customers and start building a company. So these are kind of the 4 steps to the epiphany that he's talking about. Now, if you double-click on these things, what is actually in his recommendation here? So in customer discovery, remember what we talked about as angel investor? Problem solution. Is there a good fit for what you're looking at? Proposed MVP. What is your minimum viable product? And what is your proposed fund? How do you actually go out and find these? And this is why you want to have a small target market. Like your funnel, you can't just say, oh, we will go out to everyone. If you have a very, very small target, you have a a funnel you can go out and validate. And this is why a scientific mind is very good here, because you create a hypothesis, and you start validating this. You're looking for data that proves this. And in the customer validation, you look at, is there a product market fit on this? Is there a business model? How are you going to pay for this? And how are you going to sell it to sales and marketing? And if you see that's not quite working, you pivot and go back again. And when we talked about, so when we angel investors, we see a lot of companies doing this more or less structurally. When you start seeing, okay, I got it, customer validation is not working here, now I go into customer creation and start scaling my execution. And then I start thinking about how do I build a company. So we love to engage as angel investors early in this phase. Typically, most companies come and they are somewhere struggling in these early phases here, right? And then you try, and the more structured approach you have, the quicker you will get to pivoting and find something new, and then hopefully at some point going over to customer creation. So a company that I've been following for the last year is Propio here. And Propio was a Techstars company last year, Techstars. And they pivoted a few times. Maybe, Ricardo, you can come and talk about your pivots here, right? And see what caused you to pivot. And next week, they will present to Alliance of Angels. That's one of these companies looking for funding. And there is fundraising now. So we want to talk about your pivoting?
Thank you, Magnus. Yeah, so we were accepted into Techstars last year. And the model that we were accepted into Techstars was a fintech solution for payments in the household sector. And we got into Techstars. Through Techstars, we were paired with different mentors. And one of the areas that Magnus was highlighting before about this TAM is something that came up over and over in our initial meetings with mentors at Techstars. And they were like, well, if you want to be a growth company and a technology company, the household sector, it's very limited in terms of the size. So that led us to go back to customer discovery and to start assessing, using the same problem to solve that we were doing for the household sector with other sectors, with a larger segment of the population, in this case, small businesses that serve the household sector. And that led us to our first pivot, that it was a bookkeeping solution for small businesses over messaging apps. So we went out, we built an MVP early this year. And as we were building this MVP, we were talking with multiple small businesses. And we heard from them how much they wanted to replace their bookkeeping, their bookkeepers. So we were like, okay, let's build that MVP. We built it. We came out with it, and then when we were asking small businesses to connect their bank accounts to our system so that we can start classifying their transactions into the ledger, they were like, well, I rather stick with my unreliable accountant because he's a person, no? And you looking at my bank account. So we couldn't find immediately that product market fit there. No, even when all of the research and everything that we've heard from customers was right, no, and it was in the right direction. Once we put the product out there, we're like, okay, no, we were starting to struggle. We started talking to the accountants that we wanted to replace. And that was our next pivot that happened in April, May of this year. And that changed everything for us because at that moment, they told us, oh, we want to use what you've built for small businesses and we want to license it. We don't want to refer you to our clients because that way we pay you $20 and we charge our clients $200 or $1,000, no? And that changed everything for us. And now we're hopefully getting to that, at the bottom of that hockey stick. We have a large contract with a tax prep franchise, and we're going to be launching to around 250 locations in December. No? So that's kind of that process. Thank you.
And how long was that process from your, with pretty much 12 months, right, since you started Techstars?
That's right. Yeah, we started Techstars exactly a year ago.
Yeah. So anyway, so this is kind of what we're looking for in the founder, right? They're looking for can they learn, can they adapt, can they change, and are they actually doing something different? So you didn't talk about your category, but it's essentially an AI-driven small business accounting company. So it's an accounting product, but there's some category definition around that. It's a segmentation or resegmentation of that market. Okay, we have about 4 minutes left here, so let me take a few more questions here before we end. Oh, you guys are quiet. No, you're not. Okay. Yeah.
Out of the 15 companies a year that Alliance of Angels invests in, what's your average investment amount, and does that match what other angel investors around the country are also investing?
Yeah, so there are a lot of angel groups and individual angels. So our process is that they pitch, and then each individual angel decides whether he or she wants to invest or not, right? And typically, one angel might put in $25,000, $50,000, $100,000. And then if there are multiple angels that go in, you add that up. So maybe there's 200, 300, up to, say, 750,000 is probably at the top. We also, I didn't talk much about, we also have an annual innovation fund that if we have a rule, if there's at least 2 angels in a deal, our fund will consider that as well. And then we as member of the fund, and we have 50 of us are members in the fund, we then vote, and if there's 2/3 majority who say yes, the fund adds another, I think it's $150,000. And that is, I think that's pretty normal. Typically, recently I think we've seen more smaller checks from some angel groups, $5,000, $10,000, $15,000 checks. Other questions?
Thank you. I had a quick question about the investment. So whether it's SAFE, convertible loan note. Well, 2 questions really. You said 12 cents a share to give that. Now, to give that kind of information up front, do you think it's not really letting the investor have much say in negotiations, and how would you, I suppose, frame that? Would you go, is this this is our proposed valuation, you know, give your counter offer?
No, exactly, you're right. So most cases this is a negotiation.
Yeah.
You say 12 cents, I say no.
Yeah.
I say 5 cents, and then we negotiate. But this is the role of the lead investor, because someone needs to take the lead. And sometimes we lead the negotiation as Alliance of Angels, but we prefer not to do it because there's a lot of legal paperwork involved if you lead, right? So we like to see a lead investor do the negotiation, especially if you do a price round. Now, convertible note is a little bit simple. That's why many times it's pragmatic. Then you don't need to haggle about the price more than the cap.
And for a lead investor, is there a minimum amount that you look for in terms of the percentage that you're funding, or can anybody be a lead investor no matter how much they're
Well, typically lead investor take like half the round. So if you're raising $1 million, typical lead will take 500.
Okay, great. And one more question about the convertible loan note. If you have an active convertible loan note that has not converted yet, and you're going into the round, and the round would then trigger the convertible loan note to turn into equity, what do you look out for as an investor?
Yeah, so there are a lot of details around what are the rights of a convertible note holder, and that's another hour conversation.
Okay, that's no problem. Okay, thank you very much.
I'll make it a short answer. This is about Seattle and the angel investing community. Like, do you see the craze in AI increasing the number of investors in Seattle? and the size of the investments they're making? Like, is Alliance of Angels growing in numbers and in check size?
Yes and yes. So there is a craze in AI. However, and this is also a longer conversation, we have not really seen so many successful AI startups. There's a lot, I mean, every startup is AI startups today. And we see a lot of them, and we intend not to invest in them. Like, Propy is a good example of a AI startup which has a very, very specific target market, right? That's right. Well, maybe that's good. That would be a good fit. But over the year, we've seen a lot of AI startups, and we invested in hardly any of them. And I would love to spend another hour on this. And that's not unique for Seattle. That's a big backlash in Silicon Valley that people are taking back. And we're going to see next week's, I guess, OpenAI's $150 billion round here.
Well, thank you so much for that view on what investors are thinking and looking for. I think this was really insightful. And everybody join me thanking Magnus here. Next Friday at noon, we have product marketer Ian Hammeroff, and he will be talking about the importance of competitive analysis. Sign up today, and we'll see you next week. Thanks, everybody.